myself, my name is Mike Baillargeon. I am the new Chief Operating Officer for Hearthfire. I've got 23 years of storage experience with roughly 15 of those in field operations and the balance in executive leadership roles with Extra Space and the third-party team, asset management, business development, and then growing the store space portfolio up until recently. Excited to be with Hearthfire, excited to be with Sergio and Corinn, and excited to be talking to all of you today.
Yeah, thanks for that, Mike. And as we, as you know, from being investors with us for however long it's been, the biggest part that we take pride in is executing on the business plans. And all of the projects you'll find are in various stages of that. But as we go into what we consider some more existential or external type of news headlines, and Mike's going to talk a little bit about this, it's really important for us to kind of increase our competency and our ability to execute. So the rationale bringing in Mike here is we wanted elite leadership on delivering the results for the projects. So that being said, Mike, let's talk a little bit about your experience. So there's a lot of noise out there as it relates to recessions, market turbulence. You've lived through a few of them. You've been in self-storage a lot. What have you experienced? What have you learned? What should we or might we consider doing in preparation for the year?
Yeah, so it's a good question. I've been through, I went through the 2008 Great Recession, obviously the COVID recession. Now the headlines are all about recession once again. And what I can tell you from my experience, I was with Extra Space for the 2008 recession. 2 years post-recession, when we reviewed operations and what we did right and what we did wrong, what we did right was we changed almost nothing. What we did wrong was we changed how we increased existing customer rates, and we pulled back on that out of caution. In hindsight, we should have continued doing everything the same as we had been doing prior to the recession. Good news in storage, though, even though everybody kind of likes to make changes for recessions and everybody panics a little bit, is as an industry, where other real estate classes have lost 25 to 50% of their net annual income during recessions, storage actually went through the 2008 recession and gained 5% in 2008 overall. So it's pretty recession-proof industry. I will tell you, I recommend making no changes strategically. The drivers of customer need are simply changing. So what we're seeing is we've gone from an acquisitive population. We're making more money, we're buying more stuff, we need more storage. Now, as we shift toward recessionary posture, it's thinking about downsizing. We have a lot of apartment dwellers. It's pretty easy to go from the 2-bedroom to the 1-bedroom, 3-bedroom to the 2-bedroom, and all of that stuff has to go somewhere. The other point that I think is important to consider for this particular recession is, unlike in 2008 or even in 2020, this one isn't really, aside from the inflationary pricing that's going on, eggs cost twice as much now, this isn't really being felt by most of the general population of America. Unless you're working for Google or Microsoft or Twitter, you're not, among 30,000 bank employees being laid off. Your mortgage companies aren't going out of business. You're not seeing the entire auto industry going down on this one. This is mainly being felt in the world of investment and in the world of tech. And your core customers for storage, unless you're in Northern California or some other sort of tech hub, and maybe Salt Lake City, they're not tech employees. And so our core customer, their life, aside from having to pay more for eggs and milk and cheese, isn't really changing all that much right now. So for us to change tactically would be a huge mistake. So the plan is tactically to continue adjusting market rates to make sure we're maximizing our rental activity, existing customer rates to make sure we're maximizing what we're capturing from existing customers, and make sure that the funnel is wide open at the top so that we're capturing every rental that comes by. That's in essence the simple strategy.
Yeah, and we were talking yesterday about this, and a lot of share some of your thoughts, Mike, on how over these last few years, what we're seeing now, we talked about is a lot of the shedding that we're seeing out of the industry of layoffs and what have you was an over expansion over the last year, right?
Oh yeah, I mean it's documented. I think Google's CEO came right out and said we overhired. So we overhired by about 10,000 and maybe 500 massage therapists that we have to lay off. And there you go. So this is not industry shutdown like we saw in 08, or who knows what's happening to the world like we saw in 2020. This is frankly an economic cycle that I'm seeing more and more writing on every single day is looking like it's coming to an end.
Yeah.
So we're right at that point where this is where capital investment is most profitable. So it's good that we're all talking.
Yeah, and I mean, for us, it's business as usual in terms of continuing to look for opportunities and acquisitions. We are pleased with the portfolio now. We're pleased with the direction that we're heading into our evolutionary, looking at opportunities and providing the best investment opportunities that we can go. So it's also business as usual for us. It's more about the shifts in where the jobs are, lots of noise, lots of activity around OpenAI and ChatGPT, and we expect some changes around where people are and what they are doing. But by and large, we are in self-storage for this reason. When we pivoted to self-storage from multifamily, it was anticipating some market shift. So that's not changed.